Hi, welcome to the Thursday talk on QAD Capital. This month we've been talking about the low volatility factor, and as you can see on the screen, I've added two more factors to it now, momentum and quality. And in a couple of minutes, you'll know why I've done that. But let's just do a quick review of what we've done in the month and then see how these two other factors and why I've written those two factors along with low volatility. So we saw that low volatility stocks outperform higher volatility stocks over the long run, and we discussed the various why this anomaly exists, the lottery effect, why high volatility stocks, high beta stocks behave like lotteries, where there are high odds of a small loss, but very low probability of a huge payoff. But we sort of get fixated on the huge payoff and don't pay attention to the low odds. Also, the agency effect. Why do portfolio managers fall prey to this? Is the reason why they're focused on short-term attention span and the short-term performance, and they want to see stocks that go up in the short run because of weekly and quarterly and monthly reviews. So what happens is that these high volatility stocks get overpriced and low volatility stocks get underpriced, and that's the whole behavioral rationale for why the low volatility factor even exists. Now we saw that the high risk, high reward, high return kind of adage works inter asset classes, and as we can see, equity gives you more returns than gold, currencies, bond, FD, but also has the highest volatility and has the highest return. So that high risk, high return sort of works at the inter asset level, but at the intra asset level, this does not work. As you can see here, that portfolio comprising of low volatility stocks compared to a portfolio comprising of high volatility stocks, and then you see that this is like a slowly decreasing. If this phenomenon exists, that means we divided these the whole universe into deciles, and then we looked at the returns of the 10 deciles sorted across portfolios. So as you can see, as the volatility increases, there is a decreasing return. So it's not that it just happens at the two ends, even as you go slowly along. So there is a sort of monotonical, or what you call a linear relationship between opposite relationship between returns and risk. The stock trading are the way of the stock market. We took this example by now. If you've seen the video and you've read our weekly letter, you know that which one is the orange stock, which is the blue stock, and which is the white stock. And all these three stocks sort of, the blue and the orange ones started collapsing in the mid of 2019 and completely collapsed in 2020. So the blue one was, the white one was rather HDFC Bank. The other two were IndusInd Bank and Yes Bank. And you can see the volatility of these three stocks, which give you a clue as to which stock to pick for the future. Today, I'm going to talk about the conservative formula, and the low volatility is actually at the cornerstone of the conservative formula. The conservative formula is a multi-factor approach, but basically what you do is you take a universe of stocks and divide them into high volatility and low volatility. And since we don't want the factors can be cyclical, so nothing works all the time. So what we do is we construct a multi-factor portfolio, and it's also been shown when we next month when we talk a little bit more about momentum, that momentum coupled with low volatility is an extremely robust factor which works. Most people in India use it. They just call it momentum, but actually it's momentum divided by volatility. They don't tell you that. We say it explicitly that it is momentum plus volatility, but a lot of PMSs and other curated portfolios out there are actually using momentum divided by volatility. And then we add, a value and a quality factor to it in the form of the dividend yield. And we've written a paper on it, and we're also putting up an explainer paper on it on our website. And so we've added two more factors to it: momentum and quality. Momentum, we're taking the last 12 months return, and we're taking why I've written value stroke quality is because on a global basis, when we take dividend yield or net payout yield, which is nothing but dividend yield plus the buyback yield, it gives you more exposure to the value factor. Versus in India, what we found is that it gives you exposure to the quality factor. And the original paper, the conservative formula, even there, the authors have reviewed our paper, and Pim Van Fleet of Rebecca, and they've also commented on this phenomenon that it sometimes depends on the period that you take. That dividend yield tends to sort of swing between giving exposure to value versus quality, but none the same. Value has a negative correlation with the momentum factor, so that gives you diversification. Quality also has relatively low correlation with momentum, so that also gives you a good diversification. And this is what it showed, that the conservative formula, which is basically a low volatility universe, and within that low volatility universe, then we rank stocks on momentum and quality, which is momentum we take last 12 months return, and for quality we take the last dividend yield, and we sort on that, and we take the top. In this case, we've taken 100 stocks. We've also tested on a 30 stock basis, and we found that over the long run, the conservative portfolio outperforms the speculative portfolio by a mile. And next month we'll be talking about that. And in our PMS, we have also started a 30 stock portfolio. We're calling it core equity, which is why you can see there core equity is equal to low vol, and in brackets momentum plus quality. And we'll talk a lot more about that in the next month, and we look forward to. If you have any questions on core equity, you wish to invest with us in this portfolio, just reach out to us. And with that, the standard disclaimer that this is not investment advice, it's purely for education, and please consult your investment advisor before investing. Thank you, and see you again next week with more. On Twitter, you can follow me at Anish Daily. You can follow me at QEDCap. Follow us at QEDCap. You can go to QEDCap.com and like, subscribe, and follow our YouTube channel. Tomorrow we are doing a live, which will be there on LinkedIn, on Twitter, as well as on YouTube. So if you have any questions, anything that you'd like us to address, we'll be happy to sort of answer those questions live also as we go along, and you can also send those to us in advance, and we'll answer those questions. See you next.